with our discussion of advantages, disadvantages of the corporate form of ownership. One of the disadvantages of having a corporation could be this idea of double taxation. And what does that mean? It means basically that the earnings that a corporation makes are taxed by the government. Okay, and then that money, okay, is often distributed to the owners as dividends. Okay, and if it is distributed to the owners as dividends, the owners must also pay personal income tax on it. So that's the double taxation aspect of it. But what's interesting as well is that if the company retains those earnings, okay, then it's only taxed one time, and the value of the company can grow, okay, with that money that has only been taxed once. Unfortunately, when the stock, for example, is sold later based on its inflated value, you'll be taxed. So it's hard to get around this idea of the double taxation of the corporation. This is just a quick example of, again, double taxation from the corporate versus single taxation for sole proprietorship. It's an important issue to keep in mind, but ultimately, the corporate form, if you're going to develop a business of any growth expectations or any size, it really needs to be a corporation. Okay. There's some other issues that you need to think about with respect to a corporation. This issue of corporate governance. And corporate governance is a fancy word for how the company is run and managed. So the shareholders of the company here elect the board of directors. Okay, and shareholders can be individuals, other companies and corporation, non-profits, pension funds, etc., institutional owners. They vote the common stock and elect a board of directors that represents their interests. The board has a say in most major company initiatives, strategic planning, those sorts of things. Ultimately, their most important role, in many respects, is the selection of officers. Their job is to select the corporate officers, including the chief executive, who's responsible for the running of the company on a day-to-day basis. And then the corporate officers are responsible for hiring the other managers, supervisors, and operatives in the organization as well. And so that's how it goes. The shareholders ultimately have the power, but it goes through a number of steps. Okay. Stockholders. Again, just as I said, the stockholders elect members of the board who are responsible for establishing general policies of the firm. Okay, and the board then selects a president. Okay, generally selects a president. Just a quick note: if the board actually has to vote for a president, you need to be wary of that, because if there's some vote, then there's some negative or some countervailing feelings, and that might be interesting to keep in mind. Earn a rate of return on investment. The stockholders or shareholders earn a return on their investment in a couple of different ways. One, they might receive dividends. These dividends may come in the form of cash, or there's such a thing as a stock dividend, where you get actually stock or a portion of a share of stock in lieu of cash. And then perhaps the more common way is that the stock may appreciate in value, may increase in value. But of course, this return on investment can be negative, because just as a stock may go up in value, the stock may go down in value as well. Excuse me. Public versus private ownership. Okay, when we talk about public companies, we're talking about a company that has, depending on your country's jurisdiction, let's just say many shareholders. And these shareholders often can trade this stock. Now, if it's a public company, there should be some sort of a exchange where the stock can be traded. It doesn't necessarily have to be the New York Stock Exchange or the Nasdaq Stock Exchange or the Stockholm OMX or other the London Stock Exchange, that sort of thing. But there needs to be some forum where the shareholders can trade and exchange their stock if the company is public. On the other hand, a private corporation, generally fewer shareholders. Again, the line between public and private is a legal one, and the shares are not publicly traded. That doesn't mean that they're not traded, because as you are well aware, especially if you kept up with the Facebook situation, there was lots of trading done on a special form, but it was a private form where the stock was traded among the owners. In fact, one of the reasons why Facebook needed to go public at that particular time is that it had basically passed the line between public and private, in the sense that it had more shareholders that a private company actually needs to have, and so they were in large part forced to go public. Just a quick note. Now, going public in many respects is kind of the goal, the aspiration of many entrepreneurs. And why is that? One, because you have a ready supply of capital. If you need additional money, you can sell additional shares of stock on the market. Increase liquidity, all you need to do is to sell the stock or sell more stock. You're on, again, some sort of exchange or public forum where the stock is traded. That increases the visibility of the company. Increased visibility will help in branding, could help in sales, but also increases the likelihood that you will get access to capital. The market value of a public company is very easily determined. Basically, you just look at what the price is, multiply that by the numbers of shares outstanding, and that'll give you a rough estimate of the market value of the company. In fact, it'll give you the exact market value of the company. And finally, again, unlimited lifespan. This is the same advantage of any company, basically. Disadvantages. Going public is a very heavy regulatory situation where there are lots of filings, okay, lots of financial disclosure, lots of issues in terms of in terms of the public demands on a manager of a public firm. There are certain things you can say, certain things you can't say, certain things you have to say, certain things you can't say, and you can say it on Tuesday, but you can't say it on Wednesday. And all of these things, in large part, distract from your ability to actually run the business. Okay. So what do most companies do? Of course, they have other people hired to handle these issues, but of course, that increases the costs. That takes away the focus from the ultimate objective of the company. Ownership, of course, if you're selling shares to the public market, your percentage ownership is probably reduced. While the value of the company might increase significantly, your ability to control it might be reduced. You have agency problems again, as we talked about before. The agency problems are a misalignment in the goals and objectives of the managers of the company versus the owners of the company. Double taxation is, again, any company has. But the reason this is the be-all and end-all for many entrepreneurs who are starting a firm is that this is a way that you can really monetize the value of the company. Especially in a market that is a buoyant market, a market that is going up, you can really make lots and lots of money by taking your company public, rather than a trade sale. Which is the more common way to monetize the value in the firm that you've created. Okay, impact of ownership on return. ROI, return on investment, is after-tax earnings representing in dollars or euros or kroner to the owners, and also ROE, which is return on equity. These are two ways in which returns are calculated. There are many other ways in which return can be calculated. These are just two ways. And again, here's an example of return on equity for a company. Again, return on equity is basically the net earnings of the company. Okay, the net earnings of the company divided by the equity of the company. So you can see that. You can look at this in more detail afterwards. Okay. The point. Let me go back here. The point being in this example that in a let's say if you look at the return on investment for a partnership, again, it's a pass through entity, so there are no taxes. So the value of the earnings in a partnership is going to be different than the value of earnings in a corporation. It's going to be different than the value of the earnings in a sole proprietorship. And whether or not you distribute dividends in the form of stock or in the form of cash also has an impact on the retained earnings. And the more retained earnings you have, ultimately the better off you are. But that's going to have an impact on your return on equity because your denominator is getting increasingly big while your numerator, the current net income, is probably not growing as large. So that's just a quick and dirty on return on equity. Ownership, change of ownership also has an impact on risk. Okay, on risk. Sole proprietorships, as I said, tend to be riskier than larger businesses, in large part because access to capital is not there, because if something happens to the owner, you have a problem. So it's much riskier, a sole proprietorship than a partnership or a corporation. In addition to that is this idea of a limited ability to diversify, in part because of limited skills. Not that the sole proprietor has limited skills, but a partnership with more people and a corporation with more people have a larger skills base to draw on. Ownership of existing businesses. Now, this isn't exactly forms of ownership, but it's important to think about these issues as well. One way to acquire a business, of course, is ownership in a family business. Okay. And there are lots and lots of things written on family businesses. Family businesses, in large part, tend to be predominant in many industries in many parts of the world. But they're also, because the family dynamic is on top of the business dynamic, there are many challenges in running a family-owned business. Second one here is purchasing existing business. Not all businesses that you may run and drive and be entrepreneurial in have to be ones that you actually created. You could purchase a business. Okay, and of course there are many advantages to purchasing an ongoing business versus one that you create, and you can come up with some disadvantages as well. And franchising is a way, it's not a different type of ownership, but it's a different type of organizational, let's say it's a different business model. And a franchise is basically a business that a franchisor is a business that licenses intellectual property to franchisees. Plain and simple. That's the bottom line. We'll talk a little bit more about it here, but the business owner, the franchisor, allows another franchisee to use his intellectual property. The franchisee is not owned by the franchisor. The franchisee is run and owned as an independent business. Okay, that can be owned by individual or family, or it can be owned by corporations as well. It's also important to keep in mind that many franchisors also run independent outlets as well. McDonald's. Not all McDonald's are owned by independent franchisees. A significant percentage is actually owned by McDonald's Corporation. One, because they're very profitable. Two, because they can test systems and develop additional systems and learn by actually running these outlets. Again, here are a couple of well-known: McDonald's, Burger King, mailboxes, etc., 7-Eleven, O'Leary's, TGI Fridays. I mean, all of these All of these franchisees are you can find in downtown Stockholm. In fact, some of these in a matter of a few meters from each other. I'm going to keep on going a little bit, even though that was our 15-minute time. It's important to, I think, get all of this in here. These are different types of franchisees: distributorship, chain-style business, manufacturing agreement. Okay, you can have a franchise system where the dealer, okay, is allowed to sell products produced by the manufacturer. A second is this chain style, where the firm is allowed to use the trade name and follow guidelines of pricing and sales and products, which again is closer to the restaurant type franchise that you're most well aware of. A manufacturing agreement, where the firm is allowed to manufacture, okay, a product using the formula of the franchisor. This is often a licensing agreement, is another way to put this. And a distributorship is another way to put it. Oftentimes distributorships and licensing agreements are not included as a franchise, but if we're looking at franchise being one that you are granted a license for intellectual property, you can see how they can be seen together. Okay. Advantages of a franchise situation: again, proven management style, name recognition, some sort of financial support oftentimes, in the sense that sometimes franchisees are required to send to the franchisor a marketing fee, and the franchisor groups all the marketing fees it gets from the franchisee and does independent marketing, and so they can, through this leverage effect, increase the brand name, which then increases your ability to sell and likelihood of success. Also, sometimes the franchisor will have contacts with different lenders, which will then allow you to access financing that you might not be able to do if you were not part of a franchising system. Disadvantages is, again, sharing of profits. The way that I would look at it is that you have to pay for this use of intellectual property, what is generally called a royalty or a franchise fee. Okay, and also you have less control. I mean, there are strict limits. The benefit of having a system, a proven management style or a proven system, is that you don't have the flexibility. But if it's a proven system, then maybe the fact that you don't have the flexibility is a good thing. Okay, and just as there are we've been talking about franchisees in terms of B2C, business to consumer, there are also B2B franchises, and this segment actually is growing quite a bit. Although many of the B2B franchises are very small, and as it says here, in terms of businesses that you can start from home. Okay. And just a couple more points here before we end this segment is that purchasing a foreign franchise by a U.S. firm could lead to higher returns than in the U.S. if there's less competition. If we were the first people to bring McDonald's over to Sweden, there's a chance that we would do pretty well. Okay, but at the same time, we don't benefit from the brand awareness and the marketing support and other sorts of support. So we have to kind of fend for ourselves, but at the same time, we may be successful because there's not a lot of competition. Okay, so just a quick and dirty of what we've learned so far. We've talked about the different forms of ownership: sole proprietorship, partnership, corporation. We've talked about how the form of ownership has an impact on return and risk. And we talked about a family business a little bit, purchasing a business, and a little bit about franchising. Okay, so that's the end of this particular module. Okay, talk to you later.